So you tell me, right? Down 300, up 300. Did your friend Jay Powell mess this up yesterday in the message? Former Philly Fed President Plosser says he, quote, muddled his message. What do you say?
Look, I always think, having sat at that table for 10 years, I always think of Mickey Mantle's great quote when he finished playing baseball, went up to the broadcast booth, saying, I didn't realize how easy it was to play the game until I got into the broadcast booth. Unless you've been a participant, and Charlie Plosser was, I was, I think we're a little bit too harshly critical here. We're trying to parse every single word and gesture. The economy's doing fine, as was just mentioned. And the Fed is not driving a yield curve here. Look at how rates have come down, even as they were pairing off their balance sheet. And if you look at the 10-year, it's below 2% today. Why do you think that is? It's because we're an attractive place to be. These rates are very attractive to underpin equity markets. And the short-term rate cut, I think they just gave back what they imposed in December. I would have probably dissented. I would have sided with Eric Rosengren of Boston and with Kansas City. And I think it shows you a couple things. It's a very important thing that we had two dissents. One is that there is no true consensus, or at least a majority opinion is there, but not unanimity on where the economy is. Those two argue the economy is in good shape. They're very good thought leaders. Particularly Rosengren is one of the great thought leaders that the committee always has been and continues to be. Those are important statements. And there's another aspect to the benefit of their having dissented, which it sends a signal to the President of the United States. This is an independent body. He has no control over the bank presidents. He doesn't nominate them. The Senate doesn't confirm them. And they're truly independent thinkers. So I think there are real benefits there.
Well,
one of the things I find very interesting, by the way, it wasn't long ago on this show, people were talking about 50 basis points. Mm-hmm. And now it's as though they've got amnesia on those points. And the second was because other central banks are ratcheting down more negative interest rate policy making, what I consider Pyrrhic, self-defeating monetary policy that the Fed should follow.
Well,
and I'm reminded whenever I hear that, every time I try to do something stupid that my brother Bobby did when we were little boys, my mother would always say, look, if Bobby put his hand in the toaster, would you? The answer was no. There's no reason that the Fed needs to pursue the same policy of constantly cutting like the ECB and the Bank of Japan. So I'm not as critical of Powell here. He may have muddled the message. One of the problems, by the way, is they're doing a press conference after every single meeting.
Yeah, his choice.
And that is a tough thing to do time after time after time. Mario Draghi was exceptionally good at it, exceptionally good at explaining what I consider to be terrible monetary policy. So let's give Powell a break here. And your 300 up, 300 down just indicates to me, I hate to offend the members of the investment committee, what are markets, particularly stock? They're manic depressive mechanisms. I operated a hedge fund that did really well for 10 years. But we knew that there would always be trading opportunities, and that's the nature of markets.
Right, but communication is a key part of what Jay Powell does. I didn't think he did that badly yesterday. I really didn't. Yesterday's not the only example that I was going to use. What happened in December? You use Mickey Mantle as your thing. Well, I'll go. Some people are taking what he's done recently, like Yogi Berra. When you go to the fork, take it. Well, what does that mean?
Yeah. Look, it's so easy to criticize the central bank, particularly people that have never been a central banker. You cut them some slack. The point is, it's policy. And policy is geared to the real economy, not to financial markets. I know we all like to think that they're going to do what we market operators or you market operators want. That's not the way it works. It's to get the real economy correct, not to have inflation or deflation, keep employment at its maximum or optimal level. That's the purpose of the Federal Reserve. That's the central bank. And the markets need to adjust around it. One of the points made earlier by your panel is a good one. And that is the economy continues to do well, the markets will do well.
Well, Powell said yesterday that the economy is doing well. That wasn't even why they made their move. It's more of an insurance thing. But then you tell me, you say it's about the policy. What is mid-cycle adjustment? What does that mean to you?
I actually think it's an encouraging statement. If we're mid-cycle, that means we have further upside to growth. It may not be as robust as it has been. It means that we're, I don't necessarily agree with this, in the middle of an economic cycle. I think we're closer to an end of a cycle, but we're not on the eve of a recession. And I think that's what mid-cycle means. I thought it was an encouraging sign. It means that we have further run rate on economic growth.
What do you make?
Look at personal spending in June. It was up 4.1%. Consumption drives our economy. And then again, look at these rates. I can't think of a single business, maybe the panel can, small, large, public, private, that feels that they are under financial duress and that markets are not helping them and that credit's not available. Can't think of one.
Let me ask you this. How many cuts do you think are going to happen? I'm going to ask you that because even Steve Leisman has been saying, and he said it again today, that part of the communication issue with the Fed is that they did nothing on multiple opportunities that they had to walk the market back from the idea that there were going to be 3 cuts. Nothing on numerous occasions, whether it was interviews with Steve, the Fed chair himself in speeches. What's up with that?
I don't know. You all had a very good interview with Eric Rosengren about 2 weeks ago. Again, you have to think of who's at the table and who votes. He was very articulate on this, that it wasn't required, wasn't necessary. That was his view. And if you look at who is a thought leader in that table, he's one of the great thought leaders. I would have focused on that. So you just have to play according to the real economy. We had moments where we had economic weakness appeared to be the case. And yet we have a roar back on personal spending here, which is really the key driver of our economy. The quits data is still very strong. The unemployment claims are not that great. We still have full employment in every category. So here's what I worry about. And again, with all due respect to the great market operators at the table, they hear what they want to hear, not what's being said. And the market is so hooked on cheap money that they just want to hear it's going to continue to stay that way or get even cheaper. I would suggest that the yield curve is not being driven by the Fed. It's not being driven more than 1 year out by the Fed, and rates keep going down. Who's doing that? Investors that find the rest of the world to be enormously unattractive and the U.S. to be very attractive in terms of real nominal yields.
Let me just ask you.
Money is flowing in here, and that's good for us and good for our economy.
Let me ask you just plainly. Did Jay Powell make a mistake yesterday by cutting rates? It sounds to me like you're having trouble coming to grips with the idea of an insurance cut.
No, I mean, I would have voted against it. I would have joined the dissenters, but I'm not at that table anymore. I think the economy's fine. And I think it wasn't a mistake in the sense that it wasn't as much as people had hoped and prayed for. And also, it did not indicate that it may not be just one and done. There are very few coins in the Fed's purse right now. And I would be very, very careful to spend out of that sparse little purse of only maybe 8 more cuts if possible, or 7. I wouldn't spend those coins unless I could see the whites of the eyes of the potential of a recession, and right now I just don't see them.
Well, he's obviously worried somewhat about trade policy and tariffs.
Good point.
Right,
very good point.
Do you think he needs to go more out of his way to say it? You know, he's taken all this blistering criticism from the president. Yeah. Why doesn't he just come out and say, you know what, everything's great. We don't need to cut rates, but we're going to do it because the president's trade policy has business concerned. It's showing up in some of the numbers, maybe not the ones that we generally look at traditionally, but we're concerned. Why doesn't he just come out and explicitly say it?
I wish he would say the following, and that is that even if we cut rates 100 basis points, it wouldn't quell the concerns about supply chains and all the turbulence that comes from a protectionist trade policy. And when you think about it, monetary policy has no way to offset the angst that's in the manufacturing and distribution community and the supply chain community. So I would just make that clear. We cannot do anything to offset these kind of trade policies that are being pursued by our country.
You got to believe he wants to say it.
It wouldn't make a bit of difference if they cut 50 or 75 or 100. You still would have these concerns about supply chains, where to locate production facilities. I was the deputy trade rep for 4 years. I'm sort of doubly vexed. I did that and then sat at the FOMC for 10 years. And I can tell you there's no relation between the two. What's that?
One more strike.
One more strike and I'm out? Yeah. But there's no way monetary policy can offset the concerns that these trade initiatives have raised in the business community. It doesn't equate. And I would say that, but I'm not Jay Powell, and I respect his unique role that he has to play in the way he has to guide himself through all the landmines in Washington, D.C.
Being he doesn't want to necessarily reciprocate and join this fight that the president seems intent on initiating with him. That's what you're saying.
Yeah. And again, I think he's very careful about saying that, he's not going to get involved with fiscal policy or with trade policy. That's not his role. He sticks to monetary policy. But again, monetary policy cannot offset the concerns that have been raised by these trade initiatives. And I think that needs to be made clear.
Yeah.
By the way, the president's reaction really to the decision was not as harsh as I expected. I expected him to go after Powell, not being able to control his committee, have 2 dissents, et cetera. Actually, when you think of what Trump has said thus far about the meeting, it's pretty mild.
Give it time.
I was just going to say that.
This could be just the beginning, Richard. One of the members of my investment committee, as you referenced, does have a question for you, Shannon Sakosha.
So
sure, Shannon.
I think the challenge for economists right now is that we're seeing the difference between things like PMI data and the retail spending data that you talked about. And that's going to persist. And so how do we grapple with the fact that things like leading economic indicators are pointing to a slowdown, but that's so contingent on resolution of trade? And so how do we look at that?
Well, I think they're right. The PMI is still positive, above 50. That's the key breakpoint, as you know. It's a diffusion index. There are all kinds of counterforce within our economy. One of the things I do think is an overemphasized sector is manufacturing. It's only 11% of our economy. The U.S. economy is driven over 70% by consumption and by services. We have an abundance of excess data in the manufacturing sector, and we have an abundance, by the way, of excess data in the ag sector, more data there than we even have in manufacturing. So I think there's an overemphasis on manufacturing. It's not unimportant, but you have to keep it in mind that PMI, which is weakening but still above 50, it's only 11% of the economy. I'm not poo-pooing it entirely, but if you put a gun to my head, which I hope you don't, in terms of focusing on one variable, it would be unemployment claims and employment data. Because when we have strong employment, it leads to more confidence. Look at where our savings rate is. People are consuming like crazy, and yet our savings rate is way, way up, almost historically high by recent standards. That gives you a lot of buying power to quell a little bit softness in the labor market and a little bit weakness in the economy. But we're in a really nice place right now, and I just think the Fed should gear its policy to maintaining that nice place. And I think economists have to be very careful about confusing what happens in markets, which are not unimportant, but confusing what's happening in markets versus what's happening in the real economy. And right now, the real economy is still doing pretty well, as I think you mentioned earlier in the show.
Yeah.